Well, good morning to the West Coast, Central and Mountain. Good afternoon to everyone else. My name is Brad Etheridge, and I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. We're going to share some ideas and concept strategies, tell you a little bit more information about our group, the Center for Tax Strategies and Resources, and why people become members. I have the honor now of introducing our main speaker, Walt Dallas. Walt is very, very, very smart tax attorney, and his focus of his practice and the reason that we're affiliated with him is that he provides some incredible guidance for tax reduction strategies, looking for inefficiencies, uncovering unnecessary taxes paid by our business owner clients. What our members can do is they can submit specific information, including past tax returns on a secure portal, and Walt's team will put together an analysis and look for the things that their existing counsel may have missed. And the clients can keep their existing counsel or can pick up the counsel through CPS, which is Walt's firm. He has his Bachelor of Professional Accountancy from Mississippi State University, his JD from the University of Mississippi School of Law, and his Master's of Taxation from Southern Methodist University. He's been practicing for a little over 30 years. I find him, and Simon finds him, to be very easy to talk to. The clients seem to really enjoy the time spent with him, as do the members that have used those services. And with that, Walt, we are happy to have you with us. Why don't you pop up here and say hello to everybody?
Yeah, I'm not going to show my video because I've got a message that the internet connection is a little bit lower than normal. So
Yeah.
it would be better if I don't do that so you can actually hear me. Can you see my screen okay? You should see a title screen. Okay.
Yep, we can see your
What I'll
screen.
do today is I'll go through what I previously okay. Well, that's perfect because it's prettier than I am. I can guarantee you that. And so what I'll do today is I'll build on my prior presentations to the group, and I'm going to kind of drill down into some of the techniques that we use to actually reduce the income taxes. And so what I'll do is, and we always start with this: what's a target client? We like taxable income from $400,000 to $2 million in taxable income. That's kind of our sandbox as far as doing this. And we want clients that control the method of receiving the income from the business. And we like it to be 3 owners or less. Usually, most of our clients, about 90% of our clients, are one-owner businesses. We do a lot of doctors, endodontists, dentists, optometrists, orthopedic surgeons, small business owners, that sort of thing. We will, but 1 is usually the best. 3 is okay, and then we'll just adapt from there. So that's our target client. But where we always start is that we want to start with the principles. The guiding principles are whenever we have a deduction, it has to fit into Section 162. It's got to be ordinary and necessary. And according to the Supreme Court, that means at fair market value, ordinary, and then necessary means it needs to be helpful. So if a business has an expense to be deductible, it's got to be ordinary, necessary, and it's a pretty low bar, really. The key is to make sure it has a business purpose and it's documented properly. And then our next principle is we have to have an effective corporate structure fitted into, and I'll go over that in just a second. And then is we have to have documentation, and we have a system to keep the documentation. A lot of clients just don't have a good system, and we expect them to keep good documentation, and we don't give them a system, so we have a system for them to use. And then the underlying PIN in the Internal Revenue Code is Section 77010, which has been around for about 5 years, and that's the economic substance doctrine. We've always had it; it's just been in case law, and Congress was kind enough to put it into the Internal Revenue Code, and now we know that for a transaction to be respected, it's got to have a business purpose, and it's also got to be different before versus after. So Congress did us a favor. It took it out of case law, which is kind of fuzzy, and put it into the
Walt, can I interrupt for a
Internal
second?
Revenue Code, and now we know exactly what the rules are. So we follow those. If it doesn't fit within those,
So I was just kind of going through the 4 critical elements when we do our tax plan. We measure against these 4 elements. And the one at the top, ordinary necessary, seems to be the one we always start with. Is it at fair market value, especially if it's a related party transaction? We're going to need that a little bit later in the presentation. And then, is it helpful? If it meets those tests, we can deduct it. So I'm going to build on things that we've all already gone on. We've been through the Smith case study, and what I'd like to do is look at the Smith case study and go through why we reduced the income taxes as much as we did, and then go through those particular strategies and make sure everybody understands how it works. This is kind of a typical client we see. A lot of the clients that we see, they're growing. You can see in 2017, gross income was about $798, and it continues to increase. Even in 2019, 2020, we're seeing increases in income, especially for our clients that are following our program, because we not only preach income tax reduction, but we preach gross top line income, because as far as our projects include a marketing blueprint, and so our guys are making more money each year because we're making them focus on marketing, because we're doing them a new marketing company, and it makes them focus on the marketing. And you can see salary plus business income is one of the metrics we see at the bottom, and that goes going up every year because that's what the guys are pulling out. We also look at things like rental expense, because one of the things that we're going to talk about today will be the use of the dwelling unit rental. We want to make sure that this percent of rents to gross income is always less than 10%, because that's one of the metrics that the IRS auditors look at. So we coach our clients and say, look, if you're over 10%, we got to do something different. A lot of clients will own their own business, own their own business location, and they'll lease that to their company. And so many times we'll actually reduce the rental expense and lower that rental amount in order to fit within the parameters of the metric of below 10%. We look at their advertising. Some clients are not spending enough money on advertising. One of the requirements for our clients is for them to spend at least 15% of the marketing company's budget on advertising. And so we have two groups of marketers that we send out for clients, and they'll coach the clients on how best to use their marketing dollars. And then we also look at there's a defined benefit plan that we're going to look at for 2020. Simon and Brad do a really cool thing with their defined benefit plan. My biggest problem with the defined benefit plan long term has been, gosh, you put it in and it's tax deductible, and then you pull it out and it's tax deductible at that point. It is taxable income at that point in time. They have a really cool way of exiting without paying as much income tax. I really think that's a cool way to do that. So we're going to call it the Smith case study. And then the current situation, you can see this is kind of a metric we look at too: income tax divided by taxable income. Because we get into year 3, 4, 5, 6 of our client, we have to have a metric to measure how well we're doing in the income tax arena. And you can see this guy is at 44%. So 44% of his taxable income is going to income taxes. We got to see if we can improve on that. But he starts off at $755, and then there's his state and local taxes capped out at 10, no salt tax, interest, charitable deductions. And then we get down, he's paying about $198,000 of state income taxes, and there's a state income tax. And this guy's in California. We picked California for this one. There's the Medicare payroll taxes. This guy was paying tons of Medicare taxes because he was just a Schedule C. And believe it or not, we see tons of people on Schedule Cs, even at this income tax level. And we'll correct that by moving them to an S corporation. That's a pretty simple deal. A lot of my CPA friends have already done this for a lot of our clients, so that's always nice to see. And this is what we're going to do. The stuff in green, we've got. We're going to talk about the dwelling unit rental and how that works. We're going to talk about the marketing fee and how we can prepay the marketing fee in December of every year. For a lot of our clients, we have a year-end meeting in November, and then we do an additional meeting in December to fine-tune their income tax planning, because that's the key point in time that we can really reduce their income tax each year. I've got a defined benefit plan that would be Simon's defined benefit plan that we'll put in there. I didn't put it in green because Simon will have to explain the details on that one, as he is very capable of doing. This guy's an Indian honest, and so one of the things we're really keen on trying to get is the qualified business income deduction. It's also called a flow-through deduction. and that's an additional 20% of taxable income as a deduction. We're only going to get that if we're below the phase-out levels. Phase-out levels go from 324 up to 424. Based on 2020, it actually increases a little bit for 2021. So we get our taxable income before the state and local taxes and interest salt taxes on that. To below that level, we can get the full deduction. And so we can get our taxes down to about 13%. So the question is, okay, you guys have seen this before. Those that are on the presentation probably saw my earlier presentation. But how do we do it? How do we do these three things up here? And why don't they work? Well, so we're going to say this guy before we came into deal, we were going to pay $315 of taxes, state and federal taxes. We're going to pay $90 after, so we're going to save him about $225,000, $250,000. For a guy paying almost half of his income in taxes, that's a real big deal for him. That'll let him do a lot of things that he couldn't do before, he or she, because we have a lot of gals that are clients too. So again, he goes from 44% of taxes down to 13% federal and state taxes. And so this is kind of the organizational chart we'll end up with most of the clients. They'll have an S corporation. So in our Dr. Smith, we actually would go from a Schedule C to an S corporation. He has to file an 1120S, and we'll do various things around there. One of the things we'll do, you can see, we do a de minimis meal allowance, which is Section 132. We'll be able to deduct about $3,700 for him, and then $3,700 for his wife. But this is the one I wanted to talk about, the personal resident. This is the most powerful because a lot of our clients live in very nice houses, a lot of square footage, and we'll be able to utilize the business for the house for business reasons. The most common reasons for using the house would be to have staff meetings. We see that in the doctor world, the business world, etc. And if we can have a legitimate use of the house for business purposes, we can take 100% of that as a deduction. We can do that to up to 14 days. And why 14 days? Well, that's what Section 280AG, subsection 2 says. We can do it tax-free for up to 14 days. This was a compromise in Congress. If you look at the legislative history, they actually looked at how people utilize their personal residence. Some people rent them out. Some people depreciate them. And so this says, hey, if you rent your house out for less than 14 days, you cannot take depreciation deductions. You cannot take a lot of deductions on your house. But if you rent it out for 14 days, you can take the income tax-free. So we're utilizing Section 280A, little g, little subsection 2 on that. So that's what we do. That creates a big old deductions coming out of the operating company. So the question would be, is it ordinary and necessary? Ordinary means at fair market value. Necessary means helpful. Let me go to the first one. Ordinary, is it at fair market value? So what we do is we ask the client to send us a copy of the last appraisal they got, and most people have refinanced, so it's pretty simple to find that. So we send that over to our appraiser. Our appraiser is an MA appraiser. We have no affiliation with that gentleman, and he will do a fair market value appraisal, and he will do a survey of that local geographical area and find out what's the current rental rate for places you can hold a business meeting. And he'll get that per square price of rental, and that will be the amount he'll charge. He'll do a nice MAI appraiser. Now, an MAI appraisal is the highest level of appraisal there is. You cannot get an appraisal. So generally when we see the IRS trying to battle against this, they don't even have an appraisal at all. They have somebody that gives an estimate. And so we're way ahead of the game on this. Also, the MAI appraisal eliminates any potential for penalties. We've had this litigated in tax court, through tax court and appeals. We've never had the IRS try to impose any penalties on the rental of the personal residence, interestingly. But when you have an MA appraisal, they can't do it anyway. You're relying upon a professional, and that alleviates penalties. But that has not been a problem. But nevertheless, and our appraiser, interesting, will come up with, we got a good one. He actually comes up with two rates. One will be during the week, and one will be during the weekend. And the weekend starts on Friday, ends on Sunday. And the weekend rates are generally going to be higher than the week rates. So what do our clients usually do? They have staff meetings on Friday. Staff comes to their house. Most of our clients, if they own their own business, they're going to be about 2 miles from their house. Their business and their house can be 2 miles apart. So it's real simple for the clients just to have their staff come over. They're doing the meetings anyway. Might be on a different day, but they're going to be having meetings on that. So that's one of the best business purposes that we can have. Other people, some people, I've had a recent client was a real estate agent. She's going to have her agents come in, her employees, and have those meetings at her house. She also has about 20 1099s. She's going to have those guys come in to have meetings. So she's doing meetings anyway, so we're just moving those meetings to a personal residence. What we have found with our clients is the clients have seen the employees really like going to their house. They feel like they're part of the family. It's away from the distractions. So there's a whole body of evidence we have found that having the meetings away from the office is a beneficial element. We don't have to do that. We meet the code, the code of ordinary necessary pretty easily. So the question is, okay, we've got an appraisal. We know what the fair market value is. So the question is that being helpful for the business? And we haven't had any of our meetings challenged where they've had employees there and we filled out the proper documentation. So that's our rental. That's our rental rate program. So our appraisers are coming up with about anywhere from 80 cents to $1 a foot. So if you've got a 4,000 square foot house, the per day rental, if you're going to go out in the real world and rent a 4,000 square foot house to have a rental place, would be $4,000. So $4,000 is the rental rate. Backing that down to $3,000, just to be conservative, times 14, you're at $42,000 a year. So that's kind of one of the first things we do. That's a step in the right direction. Just had a client this week had an RV. He uses RV for business purposes. We're able to rent that RV. The client uses that RV for business purposes. The S corporation pays that person for the RV, and then that is also tax deductible by the S corporation and tax free to the client for 14 days. So those two little keys, I mean, that's about $70,000 of deductions that we're doing. In this case, the case study for Dr. Smith, I did not use the RV, but that works also. We've used some of our clients have yachts. We recently did a client a couple of weeks ago. We went out and found the comps for the yachts, and we get the per day rental. And we just use that, and so that's how we do it. So that's the rental of the personal residence. And that's one of the first things we look for when we start doing it. Now, we do have some clients who just say, I just don't want the employees over at my house. And if we can't do it, we don't push that. We just say, look, if it doesn't fit you, we go on to something else. We go might do Stuffy's cash balance plan. So that's the sort of things that we do for planning. If it doesn't fit, we don't push it. We don't push a square peg in a round hole because we have a lot of tools that are available to us. And I'm just talking about a couple of them. So that's the dwelling unit rental. And then one of the next thing we'll do is we'll go, gosh, we want to do marketing services in the business development. Now, in Las Vegas, I'm going to come back and I'm going to tell you about these plans, about how they work. But it's a bit too much of a challenge to do that at one time. But we're going to do that in Las Vegas. We're going to go into how these plans work. But generally, the payments from the S Corporation is going to be a deduction in the current calendar year. And it's going to be paid over to the business development company, and that'll create a deduction for the current year. So we're in 2021, so we create a deduction for 2021, and the business development company would utilize those things in tax deductible plans over here. So that's the second thing we do. Okay, we've already paid the dwelling unit rental. We've taken $42,000 of this example as an expense. Next, we're going to pay for the marketing expenses, and we're going to do a budget for the business development company. And the budget's going to show how much we're going to spend for the business development company. And so those expenses for the remainder of the year, we're halfway through the year, so those deductions are going to be through July to December. So we're going to pay those and deduct those this year. Just create a deduction, and we saw that deduction right there. That's $80,000 based upon the budget. We're actually going to be able to do $80,000 for this guy for the remainder of the year because we're going to do various. We're going to do a non-qualified deferred comp plan also, which I'll get into the next presentation. But that will be the marketing fee for the year, $80,000. So that's a deduction off of them. Also, this company is going to have a fiscal year end of November 30th. So we've done this sort of planning for years, different fiscal year end planning for years. And cool, it's really cool because we've got an operating company with S Corporation with a 12/31 year end, and now we've got another company with an 11/30 year end. So we get to the December meeting, and I say, "How much money do you want to pay for your estimated taxes in January 15th?" And they tell me, and so if they don't want to pay anything, we'll prepay that $80,000 into the business development company. That will create a deduction for 2021 and allow us not to pay any income tax in 2021. So here we are. We paid that in. Now the code says we can prepay that up to 12 months. We can't go beyond 12 months, and that's the necessity of having a budget for that 12-month period. So we produce a budget, clients follows the budget, and then if we get audited, we can say, look, we had a budget, we were going to spend $80,000, here's the budget, and by the way, we spent $80,000. So we have that documented. We have not had any problem with that, but we've been doing fiscal year and planning for years and years and years. If the client commits to making that prepayment in December of each year, then all of a sudden, boom, we can make that. Note for this particular client, we did tons of this last year. For an endodontist, the flow through deduction, also known as a qualified business deduction, phases out completely at around $424,000. Now, in this guy's case, we couldn't have gotten that unless we reduced the income, and we reduced the income by the techniques we're talking about. This is one of those techniques. All of a sudden, we look at it and we say, gosh, we can get that income down to below 324 and take the full 20% of taxable income as an additional deduction. So that's exactly what happened in this case. And we couldn't have gotten there without this right here, the prepaying the marketing fee. So all that allowed us to get that big old deduction right there, the qualified business income deduction. And you think the client was happy getting an additional $60,000 of deduction? So yeah, they were happy. And so that allowed us to save the almost $250,000 right there. So these are the three techniques that we use on top of that defined benefit plan, the cash balance plan that Simon put in for us. And all of a sudden, we're coming up and we've saved them $250,000 with those techniques. Next time, we're going to talk about. Yes, Brad.
Well, I was just going to say, you're mentioning that second set of eyes once you guys have done the groundwork. That's worked out really, really well. We've had some members that have brought opportunities back to you. There's a form that you fill out that's a general kind of questionnaire. And then there's a secure link for sending in 2 years of their personal and corporate returns for Walt and his team to review. And then once the initial research is done, then he gets back in touch with us and we talk through things that could be layered on top of that to even greatly increase their deductions if that's appropriate for the client. And then we have that same conversation with the advisor. So it's a really nice circle. You've got a couple good set of eyes, obviously all very secured. We don't share the data outside the circle, but we can come back with some really, really big numbers for the clients on saving them some taxes. And hey, by the way, too, what we do at the center is we have quarterly, and probably going to be, I think we're ultimately going to have 3 of them per year. COVID sort of changed everything with virtual meetings last time, but prior to that, once a quarter, we would meet somewhere either on the West Coast, usually Vegas or California, get everybody together for 3 days. Well, we have one of these events coming up. It's September 29th, 30th, and the 1st, October, so those 3 days. And we're doing it, I'll show you a video here in a second of where we're doing this at, but it's a place called the Sterling Club, which is a private club in Las Vegas, just a couple blocks off the main strip. What happens is we have a huge number of our faculty members. I'll go through that list with you here in a second. They come and present, It's 3 days, but not. What's really unusual about this one coming up is this is our welcome back to meeting live. So we're really excited about it. It's been a year and a half since we've all been able to get together. So we rented a really interesting place called the Sterling Club. We have an incredible lineup of speakers and concepts. But what Simon and I and the rest of the team is most excited about is we also have set up things to do when we're not on stage, because it really, a lot of times the conversations you have on breaks or the conversations you have over a cocktail reception have a ton of value too, and we really miss that when we go virtual. So for this academy coming up, we've got a special early bird pricing to go through the 3-day program. It's including meals and cocktails. You can bring a significant other or a colleague you work with, for that matter, admin, that type of thing, for $435, and they will have things to do when we're up on stage if they don't want to attend. This Sterling Club has a full spa, a place to work out, yoga rooms with instructors. It even has its own Starbucks, a separate restaurant that's inside, beautiful gardens and walking areas. And it's across the street from a hotel that we have a room block at with discount rooms called Westgate. Breakfast is included all 3 days. Lunch is provided. We have a huge networking dinner with some wine tasting on the end of day one. Great way to get to meet a lot of other people in our industry and have a chance to speak to a lot of the experts that will be there from our faculty. And then we're going to do heavy appetizers one night. We have an illusionist that's coming back in on day 2 who's really, really good. So that'll be kind of a fun networking heavy appetizer for you. For more information, you can dial us up at 877-258-2837. We'll put this back up again later. Or you can email us if you prefer at thecenterteam@yourctsr.com. Go ahead and flip that, Bobby. Let's talk a little bit about the people that we have that are our faculty. So when I mentioned earlier that one of the advantages of the group is it gets our members access to people they otherwise wouldn't be able to have a close relationship with, or in some cases even have access to. And these folks are our superstar faculty, folks like Curtis Cloak, who is a premier retirement expert, Vince Tadana, who was the all-time producer at Guardian Life, Bruce Givner. I'm not going to go through everybody, but Bruce Givner, I think, is the smartest tax attorney I have ever met. Somebody you've had a relationship with, stuff for 20 years. Bruce is going to be there with us live in Vegas, and when he talks, people just start crowding the stage. His ideas and concepts, his ability to explain things that you can provide to your clients is unbelievably over the top. And where I think his biggest value is when I have to bring him in or ask him to come in and be involved to talk to a client's attorney or CPA, because he is definitely the biggest dog in every room that he goes into. So just a wonderful person to have access to. Kevin Knebel's the #1 most sought after business speaker in the U.S., and he talks about the world's biggest Rolodex and how to use LinkedIn to your advantage. David McKnight, I'm sure a lot of you have heard of him. He's the author of The Power of Zero. He is one of our faculty members, along with somebody that's not, oh yeah, Ed did make the list. Ed's one of our newest faculty members. I know a lot of you in the business know Ed Slott. Ed is an incredible, nationally recognized financial expert, author, and public speaker, providing training in IRAs and retirement distribution planning. Steve, I know you were there in the same area, but I don't know if we were at the same meeting. But I sat in on slots. I thought, how can you possibly do a 3-day meeting on IRAs? Every second of every day for 3 days, he was talking about IRAs, and none of it was repetitive. I was just blown away on how much content and how much his skills can be used. So our members have access to that. So you're like, we're excited to have him on board. Joe Strazzeri is another tax attorney, unbelievable. His focus is a lot of business transitions is really his kind of specialty and expertise. He's a former contractor, so here's a guy who went from business to running a business to guiding people on what to do with theirs. Super smart guy. And a bunch more. I mean, our faculty is unreal, and everybody does a section. Then we also do some breakouts in the evening, where if you want to get a little bit closer to the speaker and get into specific circumstances, they make.
Yeah, but Brad, the breakouts are for members only. So I don't want to give the people in this audience a flawed opinion of what they get. But there is going to be about 20 hours of content. Brad's going to be speaking on subject that he knows well. I'm going to be speaking probably 25 or 30 times. At least that's what it seems like. And there's going to be a lot of tangible, and there's going to be a lot of intangible. Dan Zeppelin talk about a unique niche in this industry, and that is actually giving people a fair shake on senior settlements. The majority of our industry doesn't understand that the big dogs in that industry are not there to be able to give a fair shake to the consumer. It's interesting. David Nesty is a chairman emeritus of an international tax firm, and they're going to share with us their tangible stuff and their intangible stuff. But what this really will give you is it will give you the fact that I've been able to establish relationships with almost all of these people here, Brad, a good number of them as well. And part of the reason is I know how to use them. I know how to edify them. They in turn edify me. I know how to generate revenue for them. They therefore know how to generate revenue for me. It's an interesting dynamic to learn how to play in that sandbox.
Yeah, amen. Well, let's, Bobby, show that clip a minute of the Sterling, and I'll do a little voiceover while we're going through it. The club itself is just spectacular inside. With run of the club, we have ample seating for the groups that we're expecting to attend. Once you're in the building, you never have to leave the building, and it's going to be kind of nice to have a Vegas meeting without having all the noise and confusion of the casino. For those of you that kind of like to go play in the casino, there's plenty of them around us, including the hotel across the street where we've got rooms blocked for everybody to discount. Because what I've heard, Simon, I think you saw the same thing, Vegas has been filling up really fast. There's a lot of pent-up demand out there. So, and we'll have of the folks that are speaking and at this event itself, it usually works out where we start about 8 o'clock in the morning. We do a breakfast from 7 to 8. 8 o'clock we start. We try to run till about 5:30 or 6 p.m. And we always leave time in every one of the speakers to be able to toss around the mic and have your individual questions asked and answered. And then we take a couple of breaks. Here's probably the most interesting thing about our live events and stuff I haven't seen in other places in the industry. When somebody's up there speaking, nobody ever leaves and goes and makes phone calls or goes up to the room for 20 minutes. They don't want to miss what's coming next. Now, part of that is that we do a very rapid amount of information. We really want to get this thing, as much information out as possible that you can use back with your clients. The really good news is for all of you that are registered, you'll have access to all those recordings and the presentations, and they'll be ready for you a couple days after you get back home. So you don't have to kill yourself with notes. You can actually get the main points. These rooms that they have here at the Sterling, high ceilings, very, very classy, very comfortable. We're going to do some of our social receptions right there. They've got a huge private dining area, and the venue shouldn't make that much of a difference, but you know what, for those of you who've been to meetings, it's really nice to be at a venue that's very comfortable and classy. So that's our Academy Live, the 29th through the 1st of October at the Sterling Club in Las Vegas. Register. Those fees for attending this are going to continue to go up, so we raise them every 10 days leading up to the event itself. So if you want to save a few bucks and change your practice, this would be a good place to do it.
Good deal. Can you still see my screen?
Yeah, absolutely.
Okay. One of the cool things about when you get the data in, then we can visit with one we did recently with that real estate agent from New Jersey. Is we actually did all the numbers, and we got to the numbers, and we looked at it and we said, how much does that number need to be on the defined benefit plan, cash value plan? And we backed into it. And so we were able to figure out how much that was supposed to be. And so we utilized all our other strategies, and then we backed into that number and said, oh, that's the number. And then I backed off of this right here, prepaying the marketing fee. In the client from New Jersey, we didn't prepay the marketing fee. We're not going to prepay the marketing fee at all because we were able to solve the problem with this additional defined benefit plan, the cash value plan. So what that's going to do long term for the client, because this is going to be our client forever, we're going to come in next year and say, we don't need to prepay that marketing fee. Now, this particular client has some big plans She's actually opening up another location in Florida. So if her income keeps going up like it has this year, then we're going to add in the prepayment at some point in time and utilize that. This is a one-time fee, a one-time benefit that we can get. So we pick it, we put it in our back pocket and use it when we need to. She's easy because she gets the qualified business income deduction automatically, and she doesn't have to actually do anything to get it because that's going to be automatic. So that's the way that works. Next time, hopefully I'll meet some of you guys in Nevada, and of course, what stays, what goes there stays there. So we'll have some fun, and we'll go through all the different plans that are going to be creatures of the business development company. One thing that you guys are going to look for will be inside the business development company. We're going to do a non-qualified deferred comp plan. That's that one right there. And that's going to be a non-qualified plan funded with some life insurance. And that's some of our agents, that's how they live. They sell the non-qualified deferred compensation plan inside the business development company. On a technical note, I've got, we're going to be concerned about when we form the business development company, we always use the same structure because it works so well. Gone through all that multiple times. There's been no problems with it. We always have 2 outside shareholders. So when we're talking with clients, we tell them that early on, and we explain why. Because if we have this structure, that means this S corporation, which may have employees, is going to be completely separate from our business development company, and we can do all these benefit plans just for the family members of the client. One of the big things that recently, it seems like every client we've got has been using the educational plan and paying tuition out of the business development company. And we're deducting for each child, we're deducting $5,250. That's been pretty routine. But we always tell the clients, hey, if you're going to do this, you've got to have 2 outside shareholders. There are 3 questions clients always ask. The first is, what if these guys take over? Well, they're handpicking these people, so we've never had a hostile takeover of outside shareholders. Secondly, there's not going to be very much accumulation of value inside the business development company, so there's no risk. They quit funding it, quit paying the marketing fee, and they quit funding it, and it goes bankrupt, and they call me, and we have them a corporation form in the next couple of days. Secondly, they say, well, these guys are outside shareholders. We do not want them to have any liability. They're just going to be shareholders. Like if you're a shareholder of IBM and the computers blow up, you've got no liability. Same thing for these guys. They will have no liability for this because they're shareholders. They're not officers and they're not directors. Yes, Brad.
Okay. So the outside shareholders, do you think it's possible that the service would come along and say, why did they invest in this company if we weren't paying them some kind of a dividend on an annual basis?
Yeah, I think exactly. Yeah, and in our year-end meeting, this is one of the reasons we have our defense plan, because our year-end meeting we ask, have you paid dividends to shareholders? So 100% of our clients are going to say, oops or yes. If they forgot to pay the dividends, they're going to pay them. So that's a mark, because under state law, to have a valid bona fide shareholder, they have to either be gifted stock or they have to pay money in to get stock. We require all of our shareholders to pay money to get the stock. So each of our shareholders are going to pay $10 a share. They're going to pay $480 in there. So each shareholder will pay money in there. They'll get shares of stock and they'll get dividends. So the only thing, they actually don't even have to get dividends to be a bona fide shareholder, but we require that anyway, because that's logical that they would get dividends. So each of our clients will pay dividends out to the shareholders, and our clients are normally generous with their shareholders. Great, but a great question, because we do that every shareholder. We have it documented, and we've had this audited. They ask a question, well, did they invest in the company? And we show them a copy of the check, and they check that box off, and they go to the next question. So very good point.
Okay, so let me just join in a little bit. First of all, the defined benefit plan is not mine. We use 4 or 5 different actuarial firms, and our members are free to use any actuarial firm they want. We can kind of direct them as to what they're looking for. What we bring to the table is if a defined benefit plan has a limitation of $19,000 a month that can be funded for retirement income, That's all taxable income. So with the help of some other tax attorneys, we've been able to create some exit strategies that'll reduce that taxable income by about 40%. And then simultaneously, we've been able to convince about 90% of the people that we share this with why the purchase of life insurance inside the defined benefit plan will increase the net after-tax distribution that they get out of the defined benefit plan. So instead of $19,000, which on an after-tax basis might be $10,000 of spendable income, we can increase that to about $13,000 or $14,000 of after-tax income because of the tax treatment on distributions of life insurance. So it's how we use the defined benefit plan as opposed to it being ours.
Yeah, I love that.
Yeah, and the rank and file employee costs might be too much. So it's just something to investigate. And if it doesn't work, then what we probably do is we probably put more into the deferred compensation plan. Would that make sense?
Exactly. Yeah, that's exactly where we come, because I love what you guys do, because what I don't see out in the regular marketplace is we have so many clients stuff money into a qualified retirement plan. And then I ask them, well, what's the rate what's the income tax rate? What are you going to pay at retirement?
Right.
And they go, well, I'm going to pay, and they quote their current tax rate. And that is not the rate they're going to pay at retirement. Their rate of retirement is whatever Congress and the president decide. And I think that rate's going to go up. So I like you, because you do like we do. We're involved in permanent tax savings, not just deferral. You know, if you ask some people, they'll say, fund a qualified retirement plan, go buy a vehicle, write off the whole thing. Those are just, Band-Aids. You guys have a permanent solution, and that's what we're after. We're on the same page. So Simon, you're right on the same page as we are. You're looking at permanent tax savings, not just deferrals. And the clients are thrilled, because with the non-qualified deferred comp plan, just like your plan, they're not going to pay any income. Well, the non-qualified is it's just a different plan. I mean, the non-qualified is cool because when you roll it out, ultimately, it's income tax free. And I'll go into that next time that we do today. But it's going to be income tax free. So it's not a deferral. It's a permanent tax savings. So you can solve the problem of the client in the short term, and then more importantly, in the long term, you can solve that problem, because ultimately, when it rolls out, the client's going to borrow money from that life insurance policy and not pay any income tax. It's kind of like the infinite banking concept. Same thing. Talking about that today. So same concept.
Yeah, kind of like, except that the way we're using it, it's not the answer to everything, which the infinite banking tends to say everything centers around a life insurance policy, which it obviously doesn't. So, Walt, let me ask you a question. In the defined benefit plan, it's being held in a rabbi trust?
The non-qualified deferred compensation plan is held in a rabbi trust, just the typical 409A that we've seen for years and years.
Good, because that also answers the issue of the outside shareholders rating the accounts.
Exactly. Yeah. Right, Simon. Because if the client in our example owns 4% of the stock, we're under that magic 20% number, and that allows the client to do a non-qualified. If the client owned more than 20%, all of a sudden under the 409 examples, that would be constructive receipt, and the client would have to pay income tax, and there'd be no reason to do non-qualified inside the business development company.
Right. Okay. Sorry to interrupt.
Yeah. Well, that's okay. You got me on a tangent, but it's pretty cool. This is one of the best asset protection strategies I've ever seen, because the non-qualified is held inside the business development company. The client only owns 4%. A creditor can only get what the client can get, and the client can't get into it because we've got these other outside shareholders. We've got the date of retirement stated in the non-qualified deferred comp plan, so at some point in time the client will get it. But since the client can't get it right now, the creditor can't get it. So creditors are just, it even, it's terrible to say, but it even protects the client against the client's spouse. And a qualified retirement plan can't even do that. So it's nice. It's a nice asset protection vehicle that we can put into the client's plan, because every client's concerned about the, asset protection, but very few clients want to pay money and go through the hassle of getting all that done.
Yep,
Yeah.
I agree.
A question for you,
Yeah.
Walt. How do you avoid control issue benefits with BDC only?
That's when you look at the you have two sets of rules: the affiliating service group rules, and the common ownership rules. So we have to meet those two, but both those sets of rules come back to ownership. You note these are marketing services, not management services. If you do management services, you're going to be caught by the affiliated service group rules that apply to qualified plans. So these are marketing services. We're very careful to make sure these are marketing, not management services. And so the ownership structure and also the type of services that the business development company provides allow you to have this create a separate entity for qualified plan purposes and also employee benefit purposes. We normally will put the cash value plan inside the S corporation because we have a bigger income over here. It's hard to do. I've done it, but it's hard to put a cash balance plan inside the business development company because there's a limitation of how much income we can push over there. So we're going to do that in the S corporation. In the recent case that I did with Simon, we got about 90%. I don't know if it's 80 to 90% of the tax benefits to the owner.
92.
92? Thanks,
Yep.
Brad. Yeah,
Yep.
92%. I was amazed. So that was awesome. And then on the other 8%, the client said, "Well, guys, these are key people anyway, and I don't mind them getting the benefit. Can I increase it a little bit?" And so that's been a good strategy to use. It's worked out really well.
Yeah. Just so you know, Walt, there is a wide range of magnitude of deduction in defined benefit plans. I've seen defined benefit plans with $250,000 of annual contribution and $500,000 of annual contribution. There's an art form into the defined benefit, and sometimes we use the defined benefit plan, which is income tax deductible, to move assets outside of the taxable estate, in effect making some of their estate taxes income tax deductible, where there really wasn't a real need for retirement income, but they wanted deductions, they wanted to do estate planning, and they wanted to do asset protection all at the same time. The issue is it also works for existing defined benefit plans or existing profit sharing plans or existing corporate structures where the CPA thinks that a defined benefit plan won't work because you've got to include rank and file employees. Sometimes you've got to fail some tests. There's an Internal Revenue Code section 414, that 414 MN&O, where you have affiliated service group, control group, and leasing corporations. You've got to fail those tests in order to set up a qualified plan in another entity. But even if you can't, what Walt's done here by the creation of a second business entity is to have an entity that's taxed at a lower level, number one. Number two, have some benefits that are tax deductible at a C Corp level that are not tax deductible at an S Corp or a personal level. And he hasn't done it today, but he'll do it next time we speak. And that is being able to create tax-free income out of that deferred compensation plan as well. Normally, it's fully taxable income.
Well, that's a beautiful thing. Well, I don't see any other questions at this point, Walt. And despite the rocky start there, sorry you're having tech issues. You managed to pull it off. Thank you. I just want to reiterate the procedure. For those of you that want to have a review done, you can reach out to me direct. I can get the form to you, and I also like to take a look and make sure you have all the proper paperwork submitted and that it's the right kind of case for Walt to work on. And obviously, we're looking at business owners, and we'll talk about the income and all that if you reach out to me. No, the client does not write a check. The tax returns get sent securely to a portal that Walt's team has. They're the ones who see the tax returns and all that. So if a client wants to just not give you the copy of the return, they can be submitted direct. But what a wonderful way to go back and review with a client, provide a service for them before you've even engaged in some cases. And
So Walt, let me ask you about that though. What kind of experience have you had with potential clients taking your intellectual property and doing it with their existing advisors? Do you run much risk like that?
Simon, we have not, because what we do is so technical. I've been doing it 35 years. I can't figure it out yet. And so it's very hard for them to take it back to their advisors and recreate what we do. I've never seen it happen. Of course, I probably would never see the end product. But occasionally we see somebody taking like one of the strategies and doing something with that. And like the dwelling room, they'll take that and run with it. But still, most of our clients are making over $400,000. So if you've got a guy making $400,000, they do not want to do it yourself. They want to rely upon someone that's done it before. They also want to participate in the audit defense plan. They want to know somebody's got their back if they get audited. I mean, if you got an independent making $1.5 million, the last thing they want to do is be in tax court by themselves with somebody that doesn't understand how the whole thing fits together. So there's a phrase that's been coined. It's we get naked before the client. We basically said, we're going to tell you everything we know. We're going to be 100% transparent, and that way you can make a legitimate decision. And if you take it and run with it, that's okay. We're not worried about that because you're probably not going to do it on your own.
Okay, now one more question. Does our member participate in the planning fee?
Yes. The member gets a portion of the planning fee, and it's not going to be it's a 10% fee, as I recall, and you're not going to be able to retire on that, but it's going to be $3,000, $4,000, $5,000 of a fee. So our typical fee around $30,000 to set everything up. So that's 10% of that's $3,000. The advisors are really going to make money in the non-qualified deferred comp plan on the life insurance. They're going to make money doing the cash balance plan through you guys. And then they're going to make money doing disability, because that's a layup, because we allow disability to be deducted where it's previously not deducted. And then the big ticket is they're going like, okay, we funded the non-qualified, we funded the cash balance plan, we have some extra money. What do we do with it? And then the advisor says either, let me use that for assets under management, or they do the independent banking arena. So, it depends on the advisor, what the advisor likes to do. So this has been used by a lot of our successful advisors as a great way to open the door. Once the door opens, the client sees what we do, all of a sudden they go, golly, they've saved me $100,000 a year. I mean, I don't have any advisors that do that. So that's the big key.
Yep. Excellent.
Thank you, Walt.
Appreciate it.
Thanks for having me here.
Yeah, we'll see you in Vegas. I'm sure we'll talk quite a bit before that.
That'll be fun.
All right.
Okay, we're going to make sure that the electronics work when we're there too. So because Walt, it happened to Brad yesterday because of a lightning storm.
Hey, what I'm thinking of is when we're live in Vegas, I'm going to go to the back of the room and I'm going to broadcast from there, just so we can still have that computer.
What does that? It adds something.
Yeah, so you can fall asleep. That's good.
All right, thanks, Walt.